Welcome to Taking Stock for the week ending the 18th of March 2022. Where joining me today is our Senior Equities Analyst, Jason Yin, to stream to you all things share market. Welcome, Jason.
Thanks for having me, Kien. Seems like these weeks go really fast.
Yes, indeed. Firstly, we hope you are all safe and well, and our hearts do go out to those with friends or family affected by this ongoing Russian-Ukraine conflict. And this week marked an interesting turning point for the share markets, with the US Federal Reserve raising interest rates for the first time in 4 years. Surprisingly, many growth stocks, especially in the tech sector, rallied on the news. And that's a stark contrast given the sensitivity of growth stocks to rising interest rates expectations in recent months.
Yeah, the US Federal Reserve has been flagging rate hikes for the last 6 months, and much of the news has arguably been priced in. One positive takeaway from the news conference on Wednesday night from Fed Chairman Jerome Powell, when he expressed his confidence that the US economy remains sturdy enough for the US Fed to carry out a series of rate hikes without increasing the probability of a recession.
Yeah, that's interesting, Jason. And despite the tightening cycle, interest rates are expected to remain low over the long term. The chart on screen shows this. It's a dot plot of the federal officials' interest rate expectations over the next few years. And although rates are expected to increase 7 times this year, it tapers off in 2024 to around 2.75%, as indicated by the median line in green.
But do you know what's interesting about this chart, Kien, is that it's interesting to note that the futures market, which is represented by the black line, is actually pricing in rate cuts beyond 2023. Anything could happen over the next couple of years, and central banks from other parts of the world, including UK, New Zealand, Canada, and Korea, have already begun to hike rates, and no doubt Australia will soon follow. In fact, many analysts are already expecting 3 rate hikes to occur this year, which will take the Australian cash rate to around 0.75%.
Right, so from a share market perspective, what does this all mean really? Interest rate hikes should not be a concern for investors. Remember, low interest rates are expected to continue over the next few years, and this should support equities because the money needs to find a home. In fact, the dividend income on equities remain well above yields on bonds and other asset classes. Meanwhile, the chart on screen displays the relationship between interest rates and share markets. At this point in time, referenced by the orange line, a rise in interest rates tends to correspond to rising share prices, as indicated by the positive correlation. It's only when rates become too high, say greater than 5%, do we see a negative impact to the markets. And this makes sense because very high rates weigh on economic activity and corporate profits. But this is still a long way off.
In our Taking Stock video on the 4th of March, we also showed a chart which suggests that interest rate rises have little correlation to the outperformance of growth or value stocks over the long term. Therefore, it is important that we remain disciplined to our investment objectives, focus on the fundamentals, and continue to hold a portfolio of financially healthy companies because we believe this subset of stocks offers the greatest chance to compound our wealth over the long run. Nobel Prize laureate Harry Markowitz once said that the only free lunch in the markets is diversification. So it makes sense for investors to hold at least 15 to 20 stocks in your portfolios in order to mitigate or diversify the idiosyncratic risks associated with individual stocks.
Thanks, Jace. Speaking about those idiosyncratic risks, with the widespread floods across the East Coast, a few of our clients have been wondering what impact it has to the insurers, especially for star income stock Suncorp, with the stock currently on a forward gross dividend yield of around 7.4%. Now, unlike other insurers, like for instance IAG, Suncorp's business is diversified towards banking and wealth, which makes up about 36% of its total earnings. And with the insurance division, though, the maximum liability for these events lies at around 75 million, with the rest covered by its reinsurance arrangements. And these factors limit the impact of these large number of claims on the business.
Meanwhile, the company has been able to sustain its insurance margins by pushing through double-digit home insurance premium increases over the past couple of years. This has helped sustain positive 3-month earnings revisions. Although forward earnings could be impacted by higher reinsurance costs and higher natural hazard budgets, We believe the forecast dividend yield is sustainable on the back of a declining payout ratio from 90% to 84%. Note that there are also positive earnings drivers from natural disasters because it reinforces the value of having an insurance policy, and this could lead to higher renewal rates from customers.
And hence why, Jace, there appears to be little impact of the floods to Suncorp, with earnings revisions still in positive territory. Now, within the financial space, we recently initiated coverage on Janus Henderson as a borderline star growth stock and star income stock. Just to remind our investors, a stock that has both stars does not necessarily mean it has a higher conviction than other star stocks. You really need to carefully look at the stock and its active risks to ensure that it's appropriate for you.
Since the merger of Janus Capital and the Henderson Group in 2017, the firm has evolved into a global multi-asset fund manager with strategies across equities, fixed income, alternatives, and multi-assets. But equities remains the largest portion of JHG's asset under management at 57% as of the December 2021. Overall, the myriad of investment strategies and asset classes should deliver diversification benefits to investors.
Yes, Jace, but I noticed that the outlook does not appear positive, with earnings growth expected to fall by about 8% following a raft of negative earnings revisions around 5%. So many investors would be wondering whether its growth and forecast dividend yield of about 4.4% is sustainable.
Yeah, that's a great question. The lower earnings stems from the sale of its quantitative strategy, Intech, which represented 3% of group revenue and increased marketing spend. Like most fund managers, earnings are tied to the performance of his fund managers and equity market performance. For income investors, however, we believe there is enough margin in the payout ratio of 39% to help sustain dividend expectations of $2.13.
Yes, of course. It will be tied to the volatility of markets going forward. But over the week, we also initiated coverage on a diversified miner, star growth stock IGO. The stock is suitable for growth investors seeking exposure to the renewable energy space, with the miner a producer of nickel, copper, and cobalt used in the production of batteries. The company recently established a lithium joint venture with Tuanku Lithium, and proceeds from this investment are recognized directly onto the earnings line, and that's contributing to its annualized earnings growth of around 15%. Meanwhile, the company reported a 35% decline in revenue on the back of the Tropicana gold mine divestment. Positively, though, earnings have been revised up by 28% over the last 3 months, driven by the elevated commodity prices.
And onto the corporate calendar for the week ahead, Kien. Premier Investments is likely to report, but the date has not yet been confirmed. Additionally, we have Adairs and Spark New Zealand going ex-dividend. In terms of technical alerts, for the highly trend-sensitive investors utilizing the SD Max, which stands for the Stock Doctor Moving Average Crossover, we note that Cochlear, Gold Road Resources have triggered a bullish signal, while Suncorp, MyState, and Infomedia have turned bearish. Meanwhile, those who are moderately trend-sensitive, they can refer to the SD30 TSR, which is the Stock Doctor's 30% stop loss or gain from its recent highs or lows. Now, on this indicator, both ArbCorp and Netwealth triggered an exit.
In Under the Microscope this week, we cast our lens onto oil and gas producer and star growth stock Beach Energy. The company is based in Adelaide and operates onshore and offshore oil and gas production across Australia and New Zealand, the largest of which comes from the Cooper Basin. Jace, I noticed that you are the covering analyst of this stock, but what can you tell us about Beach's oil and gas sector exposure?
The company is primarily a gas producer, with LPG and ethane contributing to 80% of its 1H22 production. Oil only represents a very modest percentage at around 20%. This means that the higher realized oil prices that we saw over the past couple of weeks would only contribute to a partial uplift in earnings.
Interestingly, its return on invested capital improved to 16.5% from 13%, despite reporting lower production volumes. But the key drivers of the profitability came from a combination of the higher oil and gas price and also favorable US dollar currency translations. But with 14 analysts contributing to consensus forecasts, is it fair to assume that expectations for a 64% increase in earnings over financial year 22. Is that reliable, Jace?
Yeah, that's a great question, Kien. No one really has a crystal ball. So we need to be mindful that earnings are tied towards volatile commodity prices and exchange rates. What this means is that forecast figures should not be relied upon 100%. Rather, I think it's important for investors to try to understand some of the demand and supply dynamics driving the oil price and then make a judgment call on whether they think oil and gas prices will remain elevated over the short to medium term.
Yes, cycles for commodity prices tend to come and go very quickly, Jace. But before making an investment decision, members should understand also the active risks. Remember, short interest on this stock has steadied at around 5% for almost the past 12 months. And these levels, although not high enough for us to wave a red flag, may reflect the heavy capital investment required into its exploration projects to sustain its future production profile. For example, Beach is expected to spend 50% of its market cap on capital expenditure over the next 2 years. During periods of heightened market volatility, investors tend to be drawn towards Golden Rule 4, share price sentiment. So the key question this week is, how can the advanced charting tool help investors manage their stock exposures? You will find the charting tool by clicking on the advanced charting button under the Golden Rule 4 chart or under the tools menu. Here you'll be able to see a history of the stock's share price, and then you can overlay it with over 100 different technical indicators, including the SD30 TSR and the SD Max. This is particularly useful for trend-sensitive investors.
Another practical feature, Kien, is the ability for investors to compare their stocks or portfolio with an index or commodity. For example, you may want to understand the correlation between the share price of, say, Woodside Petroleum to the oil price, or you want to compare the performance of the All Ords index with the S&P 500.
And the left folder bar provides a quick way for you to access and flick through the star stocks, your star portfolios, the Lincoln funds, and then compare them to your own portfolio. And under events, it's also useful to see how your star income stocks perform in the period leading to ex-dividend date or the reaction following a price-sensitive announcement.
Meanwhile, for those that want to get physical, there's the drawing tool, and this allows you to annotate your charts, draw interesting shapes, or find out exactly how much a stock has risen or fallen using the segment lines. Finally, you can download the charts by clicking on the camera icon.
As always, feel free to contact your client relationship manager if you need any help on this. But thanks, Jace, again for your insights today.
Thanks for having me, Kien.
So to summarize, interest rates remain low and rises from here tend to be positive for equity markets. Remember to separate the facts from the noise, focus on the fundamentals, and take advantage of oversold opportunities during this period of volatility. And of course, remain diversified by holding at least 15 stocks to ensure your portfolio can mitigate those idiosyncratic risks. Take care and have a happy, healthy, and prosperous week, everyone.